Can everyone see my screen?
I think, yeah, you can share it right now.
Yeah. Okay. How about now?
Perfect. That's good.
All right. Thank you, Shrikant, for bringing me onto your channel to talk a little bit about real estate investments. And thank you, everyone, for spending a little bit of time on your Sunday morning. Like it's always busy for us here in the US with weekends. So I really appreciate the time you're spending with me for the next 30 minutes or so. So today I'm not gonna talk about why real estate investments are good versus other type of investments. I'm going to talk about a project that I am working on, and I will share the details of the project. And then I will stand by to take any questions that you might have about this particular project. So with that, I will get going. So this project itself is called as the Quinn at West Chase. This property is based out in Houston. It is Class B minus. It has 369 units, and it's in one of the prominent areas of Houston. So as we talk about any project, standard disclaimer, this is a 506B syndication, open to sophisticated and or accredited investors. I'll give you a quick 10 seconds to go over this before I begin the actual presentation. All right, so this project is led by me and my business partner, Yash Havlimane. We have done several investment deals here in Houston, got more than 20 years of combined real estate experience. We are actively managing about 65 single family homes today. We are active in rehabbing and flipping of single family homes. We have multiple commercial land acquisitions in and around Houston, in and around Austin and Dallas. We have limited partnership in more than 4,000 units in multiple markets, and we have sponsored several projects as well. So that is us in a nutshell, dealing with all aspects of real estate. Now, to give you a high level of what this project is, this is 369 units, built in 1979. We are purchasing this property for $41 million. We will be spending about $2 million in rehabbing to essentially increase the value of the asset. We are getting a loan of $32 million. Loan to cost is 75%, so we need to bring in this $14 million to close this particular loan. And this is called as a bridge loan. Basically, bridge loan is short-term lending. So you take this loan for between 2 to 5 years to essentially stabilize the property to gain the maximum benefit. And we are seeking a minimum investment of $50,000. But for this group, we are opening up $25,000 for about 5 people. And beyond that, we will chat about the right way to do it, but about $25,000 for 5 people. The interest rate that we are going to go with is 4.25%. It's an adjustable interest rate. So there's a component of SOFR on top of it. So I expect this interest rate to be in the 5.5% range. It's an interest-only loan. So we start off with the initial 3 years, and then we can extend it on a yearly basis up to a maximum of 5 years. And we expect to exit at 5.5% cap rate, which turns to a return of anywhere between 90 to 125% in 5 years. And beyond this, we are also giving a preferred return of 8%. This is kind of the passive cash flow. So if you invest about $100,000, you start getting about $8,000 for you to spend on a quarterly basis. So 2% on a quarterly basis accrued to about 8. And the split profit sharing is 80% to the limited partners and 20% to the GPs after we pay out this 8%. So your money is well protected. The 5-year hold time, we expect your money to double up, and the average annual return we expect is at about 20%. And from a business plan perspective, we essentially want to go and rebrand. So this project will be called as Corridor at West Chase. So it currently has a name of Quinn. We are going to rebrand it. We will add amenities and we'll upgrade interiors to boost other income. And by the time we get done with our work, we expect the value to increase by at least $9 million. So a very high level property overview. We talked a little bit about when it was built, how many units. The average unit size is 809 square feet. The occupancy is 90.8% as of March. And as of now, end of June, we are at about 96% occupancy. So occupancy continuously increases. There are 26 buildings. There is 1 fitness center and 3 laundry facilities. And this property is zoned out to Houston Independent School District. And a portion of Houston Independent School District has this program called Vanguard, which is a program for gifted and talented kids. It's a separate school for gifted and talented. So 2 of the schools as part of the school district, the Askew Elementary and Westside High School, they are part of that Vanguard program. So pretty good place for families to stay to get good education for the kids. So location wise, I mean, I'm sure people are coming from different parts of US on this call. So for people who do not know Houston well, this is based in the west part of Houston. And as you can see here, within 5 to 10 minutes, you can reach several major employers. Houston is called as oil capital of the world. This is about 10 minutes away from Energy Corridor, where most of these energy companies are based out of. And as you can see here, I mean, there is Chevron, National Oil Well, Varco, BMC, Phillips, things of that kind. And we have 2 airports. One airport is about 40 minutes. The other one is about 45 minutes. Again, well positioned towards the airports as well. Houston's second big economy is the health system. And as you can see on this slide, we are about 25-30 minutes to the major health system here in Houston. So Memorial Hermann, UT, MD Anderson, United Airlines, Methodist. Again, most of the major employers are in close proximity. So if you are looking for an affordable place to live, and that is closer to major employers, this is probably one of the sought after complexes for sure. Now, I'll quickly go through the next few slides to share how the property is today. So these are the model units. And this is what we aspire to do with our rehab dollars as well. So this property has gone through rehab. So about 49% or so of units have gone through some level of rehab. 20% is fully rehabbed. That means most of the flooring got changed, cabinetry changed, appliances got changed. But 20% is in that category, 30% is some level of change. So as you can see, the right picture here, it still has the white appliances, which gives it a classic look. And if you look at these countertops, they are resurfaced countertops. Again, looks classic. On the left bottom here, you can see this one has stone countertops, granite countertops, and black appliances. Gives you an upgraded feel. So this is what we aspire to. Go to stainless steel or black with upgrades to the cabinets as well as countertops. Another set of pictures essentially showing you some granite finishes and some remaining as classic. So the units that we are aspiring to upgrade. So when a tenant leaves, this is a true classic apartment wherein white appliances and no proper countertops and stuff. So we aspire to improve these so that these start getting us a higher rent. So this property has 7 different floor plans. There are 2 one-bed floor plans, the smallest one being 690 square feet, the larger one being 730. 2 2-bedrooms, the smallest one 900 square feet, and the larger one 2-bedroom 2-bath 1040 square feet. And we have 1 3-bedroom plan, which is 1150 square feet, and we have 2 studios, smallest being 380 and the larger being 475. So you got an audience that we can seek and we can provide services to, because the smallest 380 costs about $650, and the 3-bedroom 1150 costs about $1,600. So we can have a clientele that we can cater to in this particular complex. So typical community amenities, I mean, if you live in an apartment, yeah, this comes with swimming pools, fitness centers, clothes care centers, and they also have the flexibility of putting a washer dryer. And as part of our ownership, we are going to put a dog park, children play areas, and grilling areas so that it gets a good community feel. And interior amenities, pretty typical again. And as part of our ownership, we want to upgrade majority of them, and we want to provide nicer black or stainless steel appliances. And some of them will get granite countertops and typical stuff that you get in most of the apartments. So this property has some interesting history. This was bought, I mean, the real reason why we see this as a huge opportunity. This property was bought in 2018, and this was given responsibility to an offsite property management company. The property management company did not really do a great job. They spent a whole lot of money. They spent about 10K a door to rehab these units, but they did not efficiently turn the units into rentable units that people would come in and stay and pay the rent. And then COVID happened. We had supply chain issues. And when it was coupled with the double whammy, we were at an occupancy of almost 60%. When the majority of the submarket was in the 94, 95%, this property struggled to be at 60%. So that is the reason that the rent you see here in this comparison chart, the marketed rent is $17. Majority of the rents that are collected in the market today are $31. So we have this huge opportunity to go in, rehab, and improve the value of this asset. And in terms of sales comparisons, there are about 24 sales that has happened in this particular area. And price per door or price per unit is $153,000. We are buying this at $110,000 a door. So again, huge improvement that we can seek with the value increases that we are going to do, with the eventual gain that we are going to see based on that particular market. And again, I mean, there is enough news that is going around about like recession, this and that. But again, this is a real asset, and most of the things that are trading here are based on the numbers that are coming out of CoStar. Now, in terms of the property mix, as you can see, there are different types of units. R means some kind of rehab. PR means premium rehabs. Premium rehabs come with granite countertops and stainless steel appliances. So we are collecting $17 per square feet. And as part of our pro forma, we want to go to $30. And the market is already doing much better than that. So we are pretty conservative with our underwriting on this particular deal, because we are still discounting the fact that we are going to be lower than what the market is already charging today. So business plan, we want to rebrand this from Quint to Corridor and add signage, create a new leasing office. We want to renovate about 200 units as they turn. Turn means, I mean, once the unit gets vacated, we want to, before we give that unit to the new tenant, we want to make some of these upgrades. We want to do some exterior improvements as well, which is we want to improve the landscaping, some improvements to the pool, foundation repairs, parking lot updates, things of that kind that is needed. We will make it look nicer. And we want to provide some community amenities too. Dog park is a big hit in the Houston area, especially for the people who live in apartments. Yeah, because they want a place for their dogs to go around and feel free. So dog park is one thing that we're going to add. And again, Texans like grilling and barbecuing. So providing an area to do that, again, is going to be something that will be cool for the tenants. Our goal again is improving the income. So we will do a few things like adding a private yard, reserved parking, washer dryers to boost income. So yeah, as I told, I mean, like basically with doing rental increases, with boosting income from other sources like yards, washer dryer connections, providing washer dryers, reserved parking, covered parking, we expect the value that we are going to see as an improvement is closer to that $9 million. And we have been working on this for a good 3 months now. Our appraisal also is done, and we are buying it for 41, and our stabilized appraisal is more than $50 million. So these numbers that were planned or anticipated are real numbers because the appraisal is done. Exit strategy. So multiple exit strategies. Basically, the first one is always give the money back to the investors as soon as you can. So we will sell it in year 3. Again, our condition will be we should be able to get at least 20% return year over year to our investors. So if we hit this benchmark, we will sell it. In the second scenario, if we cannot hit this particular benchmark, then we will extend it by another year to further work on the project. So we will extend it up to 5 years. And in another scenario, we can always refinance with an attractive interest rate and continue to run this property for the next few years. But generally, we like to exit in about 5 years so that we can we can give our investors their money so that they can plan for future investments with the written dollars. Now, why invest? So this is a cool thing where, I mean, like most of you are coming from stock investment, and I'm sure several of you have invested in apartments as well. Basically, strong risk-adjusted returns. So there is passivity in this type of investment wherein you get cash flow, unlike stocks where all the money is sitting in your trading account that you'll have to take a distribution to use it. In this case, because apartments run based on the tenants paying their rent, the cash flow generated goes back to the investors. So we expect on an average to pay an 8% cash flow to our investors. And talked a little bit about underwriting in terms of what we are buying for, what is the opportunity in terms of rental growth, and what we see as a stabilized value of this property. So because we are doing that upfront planning, the risk level reduces quite a bit. And we are well capitalized. I mean, we start off with $2 million in capital budget. And if we need, I mean, our sponsorship team is well capable of adding more dollars to the project. Very good location. West Chase is one of the places for working class. There is a lot of employment opportunities in that area. And talked a little bit about the team. The team is well experienced. I mean, we have an amazing property management team that works with us. So we don't have any doubts about achieving what we are putting on this deck. And clear business plan and exit strategy. Again, we want to be as transparent in terms of what we are doing and how we are going to exit. A little bit of financial stress test. I mean, like most of it is about how well the property holds up in case of an issue. So on every deal that we do a financial stress test. And in this case, the absolute minimum occupancy that we need is to run the show is 75%. That is the break even. And if we lose about 20% of the tenants, so if we drop down to 80%, we still are going to cash flow. We are okay. If we lose 8% in projected revenues for the DSCR, we are going to sit at 1.22. We are going to be okay. So basically, for people who are not familiar with DSCR as a term, this is basically debt service coverage ratio of 1 or above indicates that we are generating enough money to take care of our obligation. So it's like I make $1,000 and I spend $1,000. That means the DSCR is 1. I make $1,000 and spend $800. That means my DSCR is higher than 1. So higher the DSCR, better it's going to be for any investments. We have $2 million that we have allocated for spending to improve the property. From the interior side, our expenses are mostly about improving the unit itself. So we are going to add countertops, cabinetry, finish, and stuff like that. We'll be adding appliances. We are going to add flooring, and we are going to put some washers and dryers. And on the exterior side, we are going to put some new signage leasing. We are going to do parking lot improvements, some pool improvements, private yards, dog park and a gazebo, some foundation repairs, security systems to secure the property. And we are keeping a little bit of buffer out there to ensure that for unknown expenses, we have some money as well. So the actual price that we are buying is $40.5 million. And then we are going to get $32 million in financing, and we are raising about $14 million on this project. And this is how, as you can see at the bottom, this is how we have allocated at various budgets on how the spend is going to happen. Sample investment. So if you invest about $100,000, we expect to return back your money in this particular fashion. So first year about 8%, second year, first year about 6%, second year 8%. Third year, if we go through a refinance event, we expect to return about 50% of your investment back to you. If we go through a sale, we exit it at that time, and whatever profits are going to be, all those will be returned back to you. And with every investment, right, of course, we come with our best plan possible based on what we know. Plans change. And when those plans change, there is a variability. If I tell you today that I will guarantee you a 2x, then I'm lying to you. And I do not want to lie about it. I want to put everything in front of you. So the best case scenario, if everything goes our way without any hiccups, we will be able to return 28% on a year-over-year basis on your invested amount. And on the worst case, if things don't go our way, still our returns are going to be around 16%. Because you are investing into a real estate, real property, the chances of your investment going to you and nothing is very little, never happens. But when so that's the reason we are putting this range of 16 to 28%. So in an ideal way, most likely is 21. So we think the distribution and overall gain will turn out to $210,000 for 5 years. Again, 5 years is arbitrary because we want to put a box around the investment, and we will strive as best possible to make sure we exit it before that 5-year mark. So I told a little bit about how the split is going to happen. So we have an 80-20 split. 80% goes to the investor and 20% goes to the sponsor. So when does it go to the sponsor? So we have to pay all your money back. So if you invest 100, I'll have to pay you 100 back. And then every year your money is invested, I had to pay you a 8% return back. So let's say 5 years, $40,000. So I'll have to first return your $140,000 if you hold it for 5. And then any money we make after that return of investment and your 8% interest, any money we make, 80% goes to you and 20% comes to us. So our motive as such, for us to make, you have to make money first, and then the splitting will happen. So we are going to invest at least 15% of what is needed. So actually we are investing close to $2.2 million on this deal with our own money. So you should feel safe that sponsors are coming with a huge investment into the deal of their own. We are going to charge a 2% asset management fee, and there is a 2.5% property management fee. Essentially, these fees are to run the day-to-day operations of your property. So we are in the late cycle of this acquisition. We are running a little bit short. That's why, we are talking to you all today. So we are expecting to close between August 15th and August 25th. And we will accept subscriptions for another week or so. So if anyone here decides to invest, please speak to me or please speak to Shrikant so that we can get that going. And on this deck, again, it shows the best way to, the steps to follow. There's a link here if you decide to invest. So use this link to begin the investment into the project. Sorry, jumped a little bit. So this is the link for you to go in and make your investment choices. You can also invest through your IRAs. I mean, if you have a old employer IRA sitting somewhere, you can go through that process and invest your IRA into real estate through self-directed IRAs. So yeah, once you make your decision, we'll help you in any way possible to make that investment happen. And expect monthly reports from us. We send out detailed reports to the lenders between 15th and 20th of every month. Those reports are going to be available to all the investors as well. I believe in total transparency, so that transparency will be available for all of you if you join us on this journey. And I said we will start providing you distributions, and those distributions will begin in the second quarter, or like after the second quarter. So if you're invested $100,000, expect about $2,000 being paid out after the second quarter, and then every quarter after that. So first 6 months, we generally want to keep the operation smooth before we start paying money to our investors. And this is it. I will close this one. If anyone has any questions, I will. Shrikant, do you mind if I put my phone number in the chat?
Share the link and your email ID, contact details in the chat section.
Yeah, I will just pass my phone number also here. So that
Register. Can you please put in this chat section, Sudhir? That will help. Also, RK had some question. I'll just unmute RK. RK, can you please unmute yourself?
Okay, there is one question here. I'll take the last one.
Go ahead.
So 8% paid to all investors, including sponsors, before profit sharing of 80/20 began. That is correct. I mean, everyone's investment is going to be the same. They all are Class A investment, including sponsors. So any money that goes into the deal will be paid the same way. The 80/20 split will only happen after that investment is paid back in full, plus 8% preferred that is allocated to this project. So after that is paid, only then the split will begin. Until that time, all the money goes back to the investors, including the sponsors. Now there is an additional question too out there about 4.5% fee for asset management. That one is pretty standard in terms of how much the asset management is, and there is a property manager who is going to sit there and work on the property in terms of leasing. So we pay 2.5% for the property management company. Again, typical standard is 3% to 3.5% to 4%. 3 to 4 is normal, but this is a large investment or the large property. We negotiated that down to 2.5%. And the 2% that is asset management essentially is to be boots on the ground to improve the property. So all that rehab dollars that goes in, we have to make sure it is put to the best use by not overpaying any of the contractors, but by not doing things that is not necessary. So separate fees that is lower than the market, but pretty typical.
Okay. I also have a question from Virendra. I'll ask Virendra, can you please unmute yourself?
Yeah, thank you. Thank you, Sudhir, for the presentation.
Okay.
I have a couple of questions. You said one of the slides, you said it was the property is owned in 2018. Was it
Correct.
owned by someone else or was it owned by you?
No, it is someone else. We are buying it from them.
You're buying it from them. Okay.
Correct.
And at that time, when the occupancy rate was at 90%, and also now you said that it has gone up to 90, and as of March, it is 96%.
Correct.
So is what got changed between 60 that improved the market occupancy rate from 60 to 96%?
So very good question. Thank you for asking. So the COVID with supply chain hindered the property occupancy. The management, the property management team that was at the time working on this property was an offsite property man. They didn't have much of physical presence other than some employees. So once it dropped down to 60, the owner's name is Kasoro Group. They ended up firing the property managers for mismanaging the property.
Okay.
So a new property management came into play called Clear PM in 2020, and they started essentially improving the operation. So once you're at 60%, right, everything is on sale. You basically want to bring in people, giving them 1 month off, like whatever, discounting to bring people into the complex, and good paying people coming into the complex. So that's what they did. So they essentially worked on it for the entire year to bring it to that 90% threshold. But overall in that market, right, there is demand for good quality apartments. So now if you look at it, there is like a pipeline of people that are wanting to come in, and your challenge is the time that you need for people to move out and bring them back in. So that's why it is gone to about 96 now. I think it will stay in that 95, 96% through the foreseeable future, because for this size, getting closer to 100 is always a challenge. There's always going to be people moving out. You're going to be turning them around. I think we'll sit in that range for a period of time.
That follows up with my follow-up. Third last question is, you said that in order to improve, provide more amenities, you need to have this turnaround, key turned in, and so that at least you are targeting for 200 plus units to be rehabbed and re-rent them.
Correct.
Now, say I have an apartment which is renting about say $700 right now in the market.
Mm-hmm.
Now, obviously, when you put more money in the apartment rehabbing, you want to increase the value of the rent.
Correct.
And what would initiate someone to come back? Because there's always something that was being renting at 700 6 months before. Now, all of a sudden, you have a comparable. You are just upping up by 10% or 20%. Now, why would that someone want to re-rent them back or come back into the same community? Whereas if it is essentially the same stuff has been provided in the new housing somewhere, why wouldn't that be how would that be attractive?
Yeah, I mean, again, beautiful question, very good question. So we have to give the best product at the best price. Simple.
Right.
So when you give the best product at best price, people will live there. And some of the things that we are going to do. Why do people want to live in a particular place? Proximity to wherever they're going to work.
True.
A good, safe place for people to live. And basically, the simple things that people want, right? The right amenities. I mean, living in a complex gives you access to a swimming pool. So if you don't have it, you need to provide it. You need to provide a community feel for people to hang around. A dog park is a great for dog owners. A grilling area, gazebo is a great place for people to come in and do their birthday celebrations and things of that kind. These are things for which we do not charge. This is free, essentially, for you to live in that particular complex. But a lot of people choose or seek those kind of opportunities, those kind of amenities for them to come in and live in that particular complex. That is about essentially the exterior rehab. I want to provide those amenities so that my tenants or my future tenants or residents are going to make this their home for a long period of time. It's not like the 6 months lease or the 1 year lease. We want to think of them as someone coming here, living for the next few years until their situation change of some kind. Now, the second most important thing is that best price, right? Best quality, best price. I am lower in my rent compared to everyone in that particular market, because the previous management company completely screwed it up. So when I'm lowest in terms of rent compared to the entire market, and in my ownership, I'm giving the best product. Now, I seek a premium. I want a little bit more for the services that I'm going to provide. So it's a flip thing, two way to answer it. One is the tenant that is happy paying that $700, he might become unhappy and he might leave, or he might go into another unit in that same complex because it is redone, it looks new, it looks updated. So he will go to another unit and pay you $775, because people will pay if they get the quality. If they get quality and service, people will pay. But you cannot expect them to pay by giving them the same old. And that's when people will start looking for another complex to go and live. I hope it was long-winded answer, but I hope I answered your question.
Yeah, yeah, you did. Thank you. Over to you, Sri.
Thanks, Virendra. Very good questions. Yeah, it is a very nice project. And during Independence Day, July 4th, we went to Houston, and then we saw how busy the Westage corridor was. And most of the companies stay in the Westage corridor. And I mean, especially that property is a real hot asset, I would say. And the rents have been increasing every year. And Houston, I think there is a very good projection with the rent hikes as well. So I spoke to Sudhir. It was a very great conversation happened, and then I felt like I think all our subscribers in our group would definitely get help, and it is a win-win situation for everybody, because in stock market, the market has been up and down. It goes through a couple of cycle. So last year it was a very good market was up of 60-70% up, and then now we are back to 20% down on S&P. So, but the real estate, anything, whatever the profits you have, you got to know the markets, and then take out the cash and invest in, you diversify your assets into real estate. And passively, which is at something which 25,000, it is a very good investments wherever you go. If you want to buy any townhome or a single family home, anything comes with the loan, the interest you got to pay, and then you have a cash to close amount you got to pay. I mean, with the current, I say 26% investment, I would definitely go for it. So how many people you said, Sudhir?
About
Five
5, I
people.
can take at 25K.
Okay. And is there any deadline on the project?
Yeah, bulk of this has to be immediate. And if someone gets committed, let them finish the paperwork. And if they can they can send the funds by first week of August, that will be awesome.
Okay. That sounds good, Sudhir. Very well made presentation. And I
Right.
really thank everybody to join this session. And this will be This will be going as a record session in my YouTube channel. And if anybody interested, can just reach out Sudhir. Well, how do you expect them to contact Sudhir? Phone or email ID?
Yeah, I shared my phone number. There is an email address as well. So if anyone has any questions, so I'm going to put that in the chat here. So you can shoot an email there as well, and one of us will get back to you. Yeah, you can always text me, and that will be the fastest response. Emails a little bit slower, but yeah, one way or the other, we will get you the answer in a short period of time. Any question, feel free to get with Shrikant or through me. If you want to invest, we will make a way for you to invest, or we'll help you find a way to invest. So just reach out. And I want to be very transparent about everything that we do. So everything will be black and white for you all.
Yeah, perfect, Sudhir. Yeah, thank you all. If you have any questions, just let us know.
Thanks, guys.
Thank you all.
Take care.
Thank
Bye-bye.
you. And Sudhir, bye.
Thanks, Sudhir.